In 1997, world governments signed a treaty that would create a new asset class. Not stocks, not bonds. Permission to pollute. 1 metric ton of carbon dioxide became a tradable instrument, a number on a ledger, a price on an exchange. The logic was elegant. If you make pollution expensive, companies will emit less. 28 years later, global emissions haven't peaked. But the market is worth billions. The credits trade. The verifiers profit. The corporations claim carbon neutrality while their smokestacks run. And every year, at climate summits, the same question returns, quieter each time. Is this system designed to reduce emissions or to make them profitable? The answer isn't in the press releases, it's in the plumbing. And the danger wasn't in the price, it was underneath it. Here's how it works. A government sets a cap on total emissions. Companies receive or buy permits, carbon credits, each representing 1 ton of CO2 they're allowed to release. Emit less than your allowance, sell the surplus. Emit more, buy credits from someone cleaner. The theory? Pollution becomes costly. Efficiency becomes profitable. The invisible hand guides industry toward decarbonization. In parallel, a voluntary market emerged. Companies fund projects, reforestation in Brazil, wind farms in India, and to receive credits they can retire to claim net zero. On paper, it's a closed loop. Pollution flows one direction, money flows the other, the atmosphere wins. At the time, this looked stable. What no one questioned was the structure holding it up. The Kyoto Protocol didn't invent carbon pricing, but it globalized it. Policymakers in the 1990s faced an impossible task: coordinate emissions cuts across economies with conflicting interests. Rich nations had built wealth burning fossil fuels. Developing nations demanded the same right. A hard cap, mandatory cuts across the board, would never pass. So they designed a market. The logic was sound. Flexibility drives compliance. Let each country, each company find the cheapest path to reduction. Capital flows to the most efficient solutions. Everyone wins. The assumption was this: credits would represent real reductions. Projects would be verified. Baselines would be honest. The carbon removed or avoided would be measurable, additional, and permanent. It worked, but only under conditions that would not last. For a decade, the market grew. By 2005, the EU launched its emissions trading system, the largest carbon market on Earth. Billions of euros in credits changed hands. The voluntary market exploded alongside it, driven by corporate sustainability pledges. Investment poured into offset projects. Forests were planted. Renewable energy scaled. Developing nations received funding they couldn't access through aid alone. The prices reflected supply and demand. Regulators refined the rules. Exchanges emerged to facilitate trading. Verification firms proliferated to audit projects. Success bred trust. Trust bred expansion. But beneath the surface, trade-offs accumulated. Every credit sold rested on a counterfactual. This ton of CO2 would have been emitted without our intervention. Proving that required assumptions. And assumptions required judgment. Judgment became negotiable. A forest conservation project in Cambodia claimed to prevent deforestation. But satellite data later showed the threat was exaggerated. The trees were never in danger. The credits represented nothing. A wind farm in China received offset funding, but would have been built anyway under national policy. The emissions reduction wasn't additional. The credit was phantom value. Each project generated revenue for developers, for verifiers, for brokers. Each credit claimed to offset a ton of pollution somewhere else. By 2016, researchers began asking uncomfortable questions. A study of California's forest offset program found that up to 30% of credits overstated climate benefits due to flawed baselines. The methodology assumed certain forests would be logged when evidence suggested otherwise. In 2019, ProPublica investigated major offset projects across Brazil and Cambodia. The conclusion? Widespread failure of additionality. Credits were issued for emission reductions that would have happened regardless. Regulators knew, verifiers knew. But the incentives pointed one direction: approve the project, collect the fee, move to the next audit. No fraud was required. Just optimism in the assumptions, flexibility in the baselines, deference to the client funding the verification. Meanwhile, corporations accelerated their use of credits. Delta, Shell, Gucci, pledges of carbon neutrality stacked on voluntary offsets. The cheaper the credit, the easier the claim. In 2023, a comprehensive analysis of the voluntary market concluded that up to 88% of credits in certain categories represented no measurable climate benefit. Nothing collapsed. And that was the problem. The system didn't break. It adapted. Credits kept trading. Companies kept claiming net zero. Emissions kept rising. Pay attention to this part. The market wasn't failing because of dishonesty. It was failing because the incentive structure rewarded volume over integrity. Every participant, developer, verifier, buyer, benefited from more credits, not better reductions. The logic became circular. We need offsets to hit climate targets. Therefore, offsets must work. Therefore, we approve the projects. COP29 in Baku, November 2024. Negotiators gathered to finalize Article 6 of the Paris Agreement, the rules governing international carbon trading. The debate wasn't new, but the pressure had changed. Developing nations needed climate finance. Wealthy nations needed to meet pledges without restructuring their economies. Carbon markets offered a solution. Let the global north pay the global south to decarbonize on their behalf. But the cracks were now undeniable. Investigations had documented fraud. Studies had quantified overestimation. Indigenous groups testified about land grabs disguised as conservation. Greenpeace called it a bookkeeping trick. And yet, the market expanded. Because by this point, the system had become structurally necessary, not for the climate, for compliance. Corporations had made public commitments. Governments had signed treaties. Financial institutions had built trading desks. Removing carbon credits would expose the gap between ambition and action. So the rules were adjusted. Verification standards tightened. On paper, transparency improved in theory. But the fundamental mechanism remained. Pay someone else to reduce emissions, claim the credit, continue operations. From this point on, the outcome was no longer optional. The beneficiaries were predictable. Financial intermediaries profited from every trade. Exchanges, brokers, verification firms. A 2024 analysis valued the voluntary offset market at over $2 billion, with compliance markets far larger. Corporations benefited by meeting sustainability targets without operational disruption. Cheaper to buy a credit than retool a factory. Easier to fund a forest than electrify a supply chain. Developers in the global south generated revenue, but often at the cost of local communities. Survival International documented cases where offset projects displaced indigenous populations, prioritizing carbon storage over land rights. The cost was diffuse. Emissions continued. The atmosphere absorbed the consequence, and public trust in climate policy eroded as net zero became synonymous with accounting gymnastics rather than actual decarbonization. The power shift was subtle but structural. Climate action moved from regulation to financialization. Instead of banning pollution, we priced it. Instead of mandating cuts, we created a market. And markets, by design, seek profit. If you value analysis that treats financial history seriously, subscribing simply ensures you don't miss work like this. This isn't a story about carbon credits. It's a story about systems that work until they don't. Consider the structure. A mechanism is introduced to solve a real problem. It delivers early wins, trust builds, participation scales. Incentives subtly shift from solving the problem to sustaining the mechanism. By the time the flaws are undeniable, too many parties depend on the system's continuation. Prices are the headline. Plumbing is the story. The price of a carbon credit tells you what the market values. The plumbing, verification, additionality, enforcement tells you what the credit represents. And when plumbing is negotiable, price becomes fiction. History doesn't repeat events, it repeats incentives. The specific failure mode here, allowing measurement to replace action, appears across markets. Financial instruments designed to transfer risk can instead obscure it. Metrics designed to improve behavior can become targets to game. Late cycle markets share a pattern. Surface stability, underlying strain. Confidence derived from momentum rather than fundamentals. Awareness that something is structurally wrong, paired with institutional commitment to continuity. This isn't about predicting collapse. It's about recognizing when a system has optimized for the wrong outcome. Carbon credits were designed to make pollution expensive. Instead, they made pollution countable, and countable became profitable. The question isn't whether the system will fail. The question is whether failure will be visible or just reclassified as success under new accounting standards. Two things persist across financial history. First, systems are easiest to fix before they're critical. Once infrastructure, careers, and capital depend on a mechanism's continuation, reform becomes destabilizing. The correction you need becomes the disruption you can't afford. Second, incentives shape outcomes more than intentions. Well-meaning policymakers built a market to save the climate. Rational actors optimized that market for profit. Neither group was wrong within their context, but the system produced the opposite of its stated goal. This pattern, designing a solution that becomes the problem, is not unique to carbon markets. It appears whenever we assume measurement equals progress, whenever we substitute financial engineering for structural change, whenever the entities tasked with oversight have incentives aligned with the entities they oversee. The carbon credit system isn't a conspiracy, it's an inevitability. You build a market around pollution, and someone will profit from pollution continuing. Not because they're villainous, because that's what markets do. The real danger wasn't the fraud, it was the logic. And the logic is still running. If this helped you see the system more clearly, consider liking the video and subscribing. Not for predictions, but for perspective.